Oh, it's not working. Oh, there it is. Almost there. Hi, everybody. Welcome to today's lesson. We are in the middle of a coaching session for the Strategic Day Trader members, and we are also in the middle of a lesson series, and we are on lesson number 5. So welcome, everyone. Just so we are on the same page, whatever we discuss is for educational purposes only, okay? Not to be construed as a recommendation to buy or sell anything. All right, let's go ahead and get started. Before I actually do that, I have a question from a student saying, can we watch the video? Yes, I will upload it after I'm done. You can watch it as many times as you want. We are on lesson number 5, but last time we talked about trends, and that's what I call master trader key number 1, that stocks can go either up, down, or sideways. That's not an earth-shattering revelation. Most of you know that, but there's actually more to it than you think. I gave you the exact definition of an uptrend, which is, in generally speaking, is higher highs, higher lows, higher pivot highs, higher pivot lows. But we also like to add moving averages, 2 of them, 20 and 40. 40 is double the 20, so it gives you the railroad tracks when it's a really good trend. Or you can also use the 10 and 20 or the 8 and the 20 on smaller time frames. And if you have higher highs, higher lows, rising 20, rising 40, and relatively even space between the moving averages, you have what we call the perfect uptrend. When you have the perfect uptrend, your number one task becomes to play every single pullback or every single breakout off of the rising 20 MA, like so. Not one should escape your attention. Every single pullback, and when you have a trend that meets all 5 criteria, every single pullback or breakout, depending on how the stock sets up, should be playable. Every single one of them. For a downtrend, it's lower highs, lower pivot lows, a declining 20, declining 40, and relatively even space between the two moving averages. Again, I'm just recapping last week's lesson. We usually do it on Tuesday around 5:30, but I had a webinar yesterday, and so that's why I'm doing it today. Again, lower highs, lower lows, every single sell setup, every single breakdown should be playable. But we also have sideways trends. And when you have 2 or more double bottoms, 2 or more equal lows, 2 or more equal highs, we have what we call a sideways trend. Every sideways trend is temporary as it eventually breaks out or breaks down. The thing to do when you have a sideways trend is to buy the low and sell the high. Pretty easy to say, but easier said than done. It's not the easiest thing to do to actually apply, because on the way up here, let's say we wanted to short, the stock is actually really bullish. So it's hard to know when to do it. Of course, you don't get in until the prior bar's low is taken out, always. So in this case, you have, and you have to have 2 pivots, at least 2, before you can start shorting. So under this, under that, under the green bar, under this bar, let's just say. I don't know if it even triggered. And then this one failed. But these 3 worked. Now on the way up, you have to have 2 pivots. So 1, and this is 2, sort of. No, I'm sorry. 1 and 2. So pass on the first 2, 3. This one didn't really work long, so the next one worked, and the next one after that worked. Eventually, every trend breaks out or down, depending on whether the stock turns bullish or bearish. A lot of times you can tell whether it's going to break out or down because, as Jesse Livermore said, the market doesn't have to submit a legal brief for you to I don't know, to take action, to see it. So sometimes there's clues all over the place. Sideways trends are also can be they're called stage 3, which is a topping consolidation, or stage 1 when it's at the bottom. So sideways stages 1 and 3 are called also sideways trends. This is a much cleaner chart than the last one we saw, and you can see the double top and then every pivot after that, short, 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 short. The double bottom you pass, and then long, 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 long. But this one didn't reach the prior low. Eventually, every sideways trend ends. In this case, it broke out, and you could kind of tell it was about to break out because look, we had one wide range bar that retraced 80% at least of the prior move. We also had a higher low. We don't have any of that, I mean, either of these two conditions prior to this. You might say, well, what about this wide range bar? Didn't that take us to the prior highs? Yes, but it came after multiple bars. So this was an igniting bar on high volume, higher low, and reached about 80% of the prior lows. But the truth is, you didn't even need to do it because it never really triggered. It never took out a prior bar's low. And from here, the stock went higher. Okay? So just giving you a recap of last week's lesson. This is an uptrend. Notice how in an uptrend, the higher pivot highs need to be consecutive. Every letter is higher than every pivot high is higher than the one before it. Every number here, 1 through 6, is every pivot is higher than the prior pivot. And that's when you have a really nice uptrend. That's when you have a really nice downtrend. Okay? And that's a sideways trend. We already talked about it. So today so this was just a recap. Today we are going to talk about what I like to call the atomic unit, and it's master trader key number 2, or the basic unit. The basic unit, the picture you see to the right, is the only complete movement a stock or the market can make. There is no other movement possible. Your antennas should be going up here. When somebody says it's the only this, the only that, there's no other thing possible, you should immediately start thinking, that it isn't so, right? Because generally speaking, those statements like this, extreme statements, there is no other movement possible, forget about it, that's it, are not true in trading. But this one is the total truth. There is no other movement possible. Prove me wrong if you want. Send me an email, show me another movement that's actually not part of this basic unit, or what I like to call the atomic unit. So again, the picture you see to the right is the only complete movement a stock or a market can make. There is no other movement possible. The entire life of a stock and or the market is comprised of this cycle repeated time and time again. This cycle forms the basis for one's ability to predict future price movements based on the laws of psychology and probability. This cycle, sometimes referred to as the basic unit, helps the T3TT, the T3 train trader, know the current status of the stock or the market as well as what's likely to occur next. The key to trading successfully is knowing where you are in the cycle. Again, the key to trading successfully is knowing where you are, where the stock is in the cycle. And this cycle is comprised of 4 distinct stages, which are in turn ruled by 4 distinct emotions. Stage 1, ruled by ambivalence. A better word than ambivalence is indifference. Indifference means traders couldn't care less about the stock. They're just not interested. They're not interested in the stock because they got hurt. This stage 1 comes after stage 4. Stage 4 is the downtrend. In a downtrend, most traders, the vast majority of traders, professional and novice alike, get hurt. Because most people, the vast majority of people, play long. Okay, they don't play short, they play long. So a stock hurt them badly, and now it's basing. It's not going anywhere. So no interest. No interest in playing it long, no interest in playing it short. So that's why stage 1 is dominated by that feeling of ambivalence or indifference. Stage 2 is the bullish uptrend. Everybody's interested in it long, and people will just keep buying it and chasing it until it tops out. Okay, I don't want to skip ahead, but this stage is ruled by greed, and people feel that they want to be in it at any cost, And that's why we say the greater fool theory works, meaning somebody buying a stock up here would be pretty late, and yet he can still make money if he buys it up here, as long as there's another fool to buy it from him up above. So the greater fool theory works. Stage 3 is the uncertainty stage, where nobody's sure anymore about the direction of the stock. Not only are they not sure, if they're not sure, they don't commit. So nobody's willing to commit new money to the stock. You might say, but a lot of people have bought the stock already. It doesn't matter. It's always about who's willing to buy it now at this price. Because if there are no more buyers, guess what? The stock will never go up. So uncertainty, it dominates, rules stage 3, and stage 3 is unhealthy. It's a topping pattern. It's a distribution base, leads to a stage 4, a nasty stage 4 downtrend, which is completely ruled by fear. And when fear becomes panic, that's when the stock usually bottoms. So when finally everybody starts to rush out of the stock, that's when it actually bottoms. That's why we look to play these stocks that are going climactic, like so, right? Because it means they're bottoming. Actually, the best play yesterday for me was UXIN in the room, on the mic in the room. Why would I play a stock that's falling apart like this? By the way, I picked it up at 151 and at 158, two entries. Why? Because it's running out of demand. How do you know? Well, you don't know for sure, but there are clues, such as the wide range bars, the volume. Look at the size of the volume. So when you start to see the big volume, that's indicative, again, of a lot of people getting out of it, a lot of people panicking out of it. Look at the size of the bars. Compare them to the average size bar. That's average size. This is big, and that's bigger, and that's biggest at the bottom. So it becomes climactic, and sometimes they don't bounce very much. They bounce a little bit and they go sideways, but usually we say the worst is over. After the stock goes climactic, the worst is over, and from there the cycle repeats. From there the cycle repeats. In stage 2, the T3TT focuses on buying most of the time because you have an uptrend. You don't want to be shorting an uptrend. In stage 4, you want to focus on selling most of the time because the stock is in a downtrend. In stages 1 and 3, you can do both. However, in stage 1, you want to focus more on buying because you know after stage 1, you always get stage 2. Now you might say, well, wait a second, how do I know it's stage 1 versus stage 3? There are characteristics to both stage 1 and stage 3 that are completely different. It would be outside the context of today's lesson, but we'll get to it in future lessons. But also remember that stage 1 always comes after stage 4. So if you have a downtrend and then you have a base, it can either continue lower, and this would be a continuation base, or it can reverse. This can never be called a stage 3. If you have a downtrend and you have a base, so one more time, if you have a downtrend, you have a base, it can never be called a stage 3. It's either a stage 1 and higher, or just a pause that refreshes and the stock continues lower. So stage 1 always comes after stage 4, and stage 3 always comes after stage 2 uptrend. Okay, so just if all else fails, just remember that. Now the cycle is made up of 3 primary trends, and we said uptrends, downtrends, and sideways trends. We'll talk about that in a minute. Here is perhaps the most important thing to keep in mind. The only way to win. Traders who win consistently, no matter what time frame, whether you're playing day trading, playing the 5-minute chart, swing trading, playing the daily time frame, or core trading, position trading, long-term trading, playing the weekly and the monthly time frame, no matter what time frame, have simply learned to play the cycle or unit in this manner. They buy somewhere during the start of stage 2 and sell somewhere before stage 4 begins, or at the beginning of stage 4. So you buy somewhere here, you sell up here also. You can sell up here if the stock goes climactic, up, and goes climactic, get out of it. Don't wait for it to roll over. Or if it just goes up and then slowly rolls over, then you get out of it right here, depending on whether the stock goes climactic or not. So again, they buy somewhere during the start of stage 2 and they sell somewhere before or at the start of stage 4. This is something that's even more important, the only way to lose. Traders who lose lose by unconsciously playing the stock cycle in this faulty manner. They buy somewhere at the start of after stage two is proven to all, and they sell after it was obvious they were wrong. So this is the secret to trading, is that it's not about what has already happened. It's about what's yet to happen. So you always want to be thinking about what's about to happen. You want to be proactive, not reactive. You want to be focusing on forecasting rather than reading history. What's the name of the business we're in? Speculation. So you have to speculate. But you simply cannot buy after something, after you're 100,000% sure that the stock is bullish and then decide to buy. That would be the wrong time to buy. For example, QCOM. Truth be told, students in the strategic day trader room that are listening to me now know that I said this multiple times. I said this would be back when it was at 50 bucks. QCOM at the prior lows. This is major support. Buy it here somewhere if you can. I couldn't because I couldn't figure out a way in it. It was in a downtrend. I didn't know where to buy it. I knew it was in the right area, but I didn't know where to buy it on the daily chart. So I ended up not buying it. But that would have been the right time to buy it here. The ones that waited too long are now maybe buying it up here. That would be the wrong time to buy it. So you don't want to buy after a stock has proven beyond a doubt that it's really bullish. By that time, it's too late. If it's too obvious, it's too late. Equally, you don't want to sell after you're 100,000% sure you're wrong. The stock goes from $100 to $5, and you say, well, yeah, I guess I thought this was going to be the next Apple, the next Tesla, and it isn't. Let me get out of it. Duh, you don't get out of it now. You should have gotten out of it when it started breaking down, maybe under at 90 bucks, at 80 bucks, but not at $5. So you don't want to be getting into stocks after they are obviously bullish or bearish. At the start of the turn is when you want to get in it. And similarly speaking, you don't want to be getting out of it after you're 100% sure you were wrong about the play. Get out of it the moment it starts to look bearish or starts to go against you. Okay? And that's why this is perhaps the most important slide that you're gonna, if you take anything out of today's lesson and you just take this, it was well worth your time. I assure you of that. All right. Okay. Now here's the four-stage cycle, the only movement possible on monthly charts. Why monthly charts? Do we not see the same cycle on intraday charts? Oh, sure, we do. But I mean, we were just talking about this, right? Here's this pattern. We were talking about this. That's the cycle on the 15-minute chart, right? But on the monthly chart, it shows it better because it's very clear. This is 3 years worth of basing, then the stage two uptrend, then the top. It wasn't a base, it was just a pivot, and then the stage four, and then the cycle repeats. Notice stage one usually has small bars, right? And so you can see the cycle better on larger time frames. Again, another cycle, another atomic unit. Stage one at the bottom, small bars. Why small bars? Why? Why is that a characteristic of stage one? Because nobody's interested in it. So the stock is not going anywhere. Does that make sense? It's not going anywhere. Nobody's interested in it. When it starts to move up, that's when people start to get really interested. And that's, I don't blame them because it's moving. Here at the bottom, it's not moving. Nobody's interested in it. And stage three, the top, stage four, the downtrend, and then the base. Okay, more of the same, except this took a double top for it to really top out, like an M pattern. And notice how small the bars are. And trust me when I say this, I know people in my extended family even that during the tech bubble were in stocks from 250 and they rode them all the way down to pennies or $1. So this is not, from 140 to like $10 or $5. It happens all the time. and people ride it all the way down to the lows, which is wrong. You want to be out here maybe. Okay, at $100, or that's not at 140, you missed the top, but that's better than getting out at 20 or at 40 or at 60 or at 80. So you want to be out, if it goes climactic, you want to be out, try and get out at the top. If it doesn't go climactic and it pivots or it rolls over, then if it doesn't go climactic, just under the prior bar's low. You'll capture 90% of the move still. Okay? More of the same. So, and then again, sometimes you can see you don't get a pivot, you get a rounding top. Like here, you get a rounding top. This is the daily chart. A rounding bottom. I love rounding bottoms, rounding tops. Uh, they because it's easy to catch these when there's a rounding top around it. That's why I didn't catch the QCOM, even though I said to the room, this is the place, the time, and the place to buy it when it was at $50 at major support on the monthly chart. I still didn't catch it because it was hard. But when you have a rounding bottom, it makes things easier, right? Where do you short? Just off the declining 20. As soon as it starts to curl, just under that bar's low, short. I have a bad tick here, I'm sure. Uh, on the way up here, as soon as it pulls back, it goes above it, pulls back to it, long. So right here would have been a good time to play it. Right here would have been a good time to play it. Okay, anyways, okay. So this is master trader key number 2. A stock or a market, remember this, a stock or a market can only be in one of the 4 stages at any given time. So it can't be in stages 2, it can't be in stage 2 and stage 4. That would be, it can't be in an uptrend and a downtrend on the same time frame. It can only be in an uptrend or a downtrend. But it can be, however, a stock can be in different stages on different time frames. For example, QCOM is clearly in an uptrend on the daily chart. But was it, I mean, I made $1,000 shorting the QCOM today in the room, almost $1,000. Was it in a downtrend at some point? Oh, sure. I mean, it was a novice gap, and I shorted the QCOM this morning with the room. Almost at the open, it just did a double top first. So I didn't do the first sell setup. Here's the first sell setup. I didn't do it. Once it went up and then failed, then that's when I did it. So did it downtrend for a while? Sure. Was this a 1 minute downtrend? Lower highs, this high is lower than prior high, right? Yeah, it was. And it continued lower. But was this in an uptrend on the daily chart? Yes, it was. So here's an example of a stock that was in an uptrend on the daily, but in a downtrend on the 1 minute chart, let's say. But it can never be in an uptrend on the daily and in a downtrend on the daily at the same time. So it can only be in one of the 4 stages at any given time on any given time frame. Identifying which stage a stock is in is vital to successful trading. It helps to reduce losing trades and adds a quality to one's decision making that is unrivaled. The T3TT never places trades without first knowing which stage those trades are being done. Remember that. Never places trades without knowing which stage they are being taken in. All the trader needs to do is learn how to handle himself in each of the 4 stages. The T3TT, who knows how to handle himself in all 4 stages, has about 85% of the market's activity covered. The T3TT trades with the flow of each stage 90% of the time. You want to go with the trend 90% of the time, and using the appropriate trading tools and tactics, the T3TT only goes against the flow of the stage roughly 10% of the time, unless you're a specialist. I have a member in the room with me that's been trading with me ever since I started. So since 2007. I started in 2005, but I wasn't in the room. I wasn't in the room that I'm currently in until 2007. And she's been trading with me since then, and the only thing she does is climactics, is going against the trend. Because that's being a specialist. If you're a specialist, that's fine. But for the general trader, most of the time, it's better not to go against the trend. And if you want to do it, just make sure you're very, very picky. You only do it about 0 to 10% of the time. Now, as we said, there's only one cycle or movement a stock can make. We call this the unit or the atom. But this cycle is comprised of 4 stages. But this cycle and the 4 stages are made up of 3 primary trends. So the stock doesn't go up in a straight line. It goes up and down, up and down, up and down. But notice it's in an uptrend, higher highs and higher lows. Each trend should have its own matching trading actions. So you need to learn tactics for each trend, uptrend, the downtrend, and the sideways trend. And consider this, while stages 1, 2, 3, and 4 can occur inside a macro stage 2, the entire atom can develop a longer stage 2 and a shorter stage 4, resulting in a stage 2 on yet a bigger time frame. And that's why some stocks, if I tell you, if I tell you this is the only complete movement possible, you might say, well, come on, Sami, that's not true. Look up Apple, or look up, this is, it always goes higher eventually, right? It's been going higher, higher, higher. Where's that complete cycle? Yes, there is a cycle. Here it is. It goes up, down, up, down, up. But notice the higher highs and higher lows. Does that make sense? So it just doesn't go all the way back down. So sometimes the cycle that I'm talking about happens like so, with higher highs and higher lows inside of a larger macro uptrend. Does that make sense? And those are the ones, that's what I call, these are the stocks that escape gravity. The vast majority come all the way back down. That the good ones, like Apple, Microsoft, you name them, the brand name stocks basically have, over time, didn't really retrace all the way back down. Okay? And they've managed to put in higher highs and higher lows. Now, this is for next time. We're going to talk about transitions. The stages are divided or linked by 4 transitional phases. The 4 transitional phases tend to be the most difficult periods to trade, but most difficult means most rewarding also. Why would I want to teach you something that's difficult to trade? Because it's also the most rewarding. If you can catch the stock right here, it means you're catching it at the bottom of that stage 2 uptrend. This is where the stock has the highest reward to risk it will ever see. Okay? So that's the best area to get in it long. That's the best area to get in it short, at the top right here, stage 3. The highest degree of mastery can be attained when the trader can not only identify the stages, but can tell with great likelihood at the earliest moment when they are about to change. We call that the transitional phases. Transitional phase A, transitional phase B, transitional phase C, and transitional phase D. We're going to learn that all, we're going to start at least next time. For now, I just want to let you know, if you enjoyed this video, then you don't need to do anything else. I'm glad you did. I hope you found benefit in today's video. But if you would like to learn more and participate in some of the trades that I call in the room, we have a great offer for you as a new member. We'd love for you to be part of our trading room. You can actually join me for 30 days for only 49 bucks and trade with me in earnings season. How about that? The best time of the year. Earnings season is just starting. So there's a link in the description where you can join me for the next 30 days for only $49. Next, in the description of the video. The strategic day trader room was twice won the award for the best trading room by Trader Planet, as voted on by the trading public. So it is a real serious room for serious traders. All right, and it's run by 3 professional traders, myself included. I hope you enjoyed today's video. I'm also going to be doing a webinar, a class on how to trade earnings season like a pro this weekend. There's also a link for that in the description of the video. Be sure to check it out. You can also catch the webinar replay, yesterday's webinar that I did. If you couldn't attend, you can catch the webinar replay also in the link that I dropped in the description of this video. With that said, I hope you have a great evening, and I'll talk to you next time. Good trading, everybody.